It's Brian Preston, the money guy.
Bo, there's really, we took, because like I said, there's some talking heads out there, some really loud voices, and we came up with 5 things to kind of help you navigate this. The first one that I think people are trying to figure, and we started with a big one, is number 1, house prices aren't going down. Now, this is, because think about Dave Ramsey, and then we got Graham. You know, they kind of have some separation in their opinions on this. Let's hear what they have to say.
Yeah, so here's what Dave says when it comes to what's going to happen with house prices moving forward.
House prices are going to go up every year for the next 5 years. If you're ready to buy, you're in good shape financially, you need to buy now. Don't wait on house prices to go down. They're not going down. What goes up must go down. No, it doesn't.
So this is, look, we have a lot of young employees here at the firm.
Yep.
And they've given themselves a name of Team Crash.
Sure.
That they are waiting for the market to collapse so they get their ability to buy in. Dave is kind of crushing all those hopes and dreams by saying, look, if you think that this market's going to collapse upon itself and you're going to get the pricing you could have gotten in 2018, 2019, he's saying it's not going to happen.
And he's saying they are not going to come down, and he's pretty emphatic about that. But he's not the only voice out there. For those of you who aren't familiar with Graham Stephan, he's a popular YouTuber out there, does a lot in the real estate space, is a real estate investor, formerly a real estate agent. He has some thoughts on what's going to happen with the prices of housing moving forward. Check out what he has to say.
First, we should talk about what most people want to know, and that would be when the housing market is going to come crashing down. And as a buyer who's actively scouring the market myself, the honest answer is it depends where you're looking. With real estate, it's difficult to place a one-size-fits-all approach across everything, and some markets have even begun to see a net decline.
Okay, so Dave said that housing prices will not decline, and Graham says, well, it kind of depends on where you are. Location matters. So if I'm out there, I'm in the audience, I'm a listener, and I'm trying to figure out, are house prices going to go down? What's the answer? Which one is right? And what's sort of the money guy take on what's likely to happen with house prices?
Well, Dave, if we were sitting down with Dave, I'd say, Dave, I need you to give me a little more clarification. Are you saying all markets are going to be the same, or are you more nuanced, kind of like where Graham is, where location is going to have an impact? And the reason I would ask that question is that I have knowledge of what I've even experienced. Because think about this, guys. In 2000, I bought my second house in 2003 in South Atlanta. Nice home. I've shown pictures of it in the past. I watched that house go from being worth $550,000 to $225,000
over the course of less than 2 years.
Yeah, it was less than 2 years. I mean, this thing fell off a cliff in the downturn. Meanwhile, we were checking out this Nashville area in the 2010, 2011 period, starting to do some due diligence and research. And I can tell you this area, even in the darkest of times of that 2008 to 2011 collapse, really lost 10 to 15% at the most.
Very different than
it
what we
was
saw.
not a 50+% collapse like South Atlanta was. So I can't help but think that if there were going to be some fluctuation in pricing, it's going to be kind of where Graham was going, where location will be a driving factor there.
So if you're in one of those situations where you're trying to make a housing decision, you have to kind of do some assessment on the area in which you live. Are you living in an area where a lot of people are moving to, where demand is still high? If that's the case, there's a really good chance that housing prices might not decrease. But if you live in a different area where maybe the demand isn't there and we see economic softness, perhaps, and it sounds like Graham is saying we're already seeing this, home prices come down. So you have to kind of look specifically at where you are and where you're looking to purchase to know the answer to that question.
Yeah, if you said it, I'll just say it in a spiffy way. We're in a hot market here in the Nashville area.
Yep.
A lot of people are trying to migrate into this area. So housing prices, even for Team Crash, I kind of agree with Dave on that. They're not going to collapse. Now, if I was still living in South Atlanta, I might be a little more strategic with trying to play that market a little differently.
So then that naturally leads to the second question. If housing prices don't decline and they're going to continue to increase, Will the rate at which home prices increase slow down? Meaning, is this whole 35% over the past couple of years going to be something that maintains, that something that stays, or will we see that slow down? Let's see what Graham has to say about that.
I've said this before, and I think it's worth repeating again. The Calculated Risk blog pointed out that we could be following a very similar trajectory to real estate prices in the 1970s, which were also plagued by rising prices, skyrocketing mortgage rates, and high inflation. But here's where things get interesting. During that time, home prices continued going higher in terms of a dollar amount, but real returns, when accounting for inflation, fell by 11% over 3 years, meaning home prices went up, but the net value declined. After all, median home prices are up 10.9% year over year, but inflation was 9.1%, meaning home prices only increased by 1.8% above inflation, which is completely in line with the historic average. That's pretty eye-opening, right?
So what he's saying is that home prices in the 1970s, even though they were getting higher, they were just barely keeping up with inflation. So in terms of real increases, they weren't increasing a ton. They were increasing by about 1% per year on average, even though the nominal price was going up. And he's saying, a lot of the stuff we're seeing right now, that could also be the case. Home prices may not outpace inflation moving forward if we're moving into a super high inflationary environment.
Well, thank goodness. I mean, think about it. Markets went up 36% in less than 2 years. That's not sustainable. So I think it is very reasonable to expect, yes, houses will still continue to go up, but they're going to be at a much more moderate pace, maybe even less than where inflation. That's what Graham was saying. What does Dave have to say about this?
And so what happened was we came out of the pandemic quarantine and the economic suppression. People were trapped in their homes. They decided they didn't like them and they needed to go buy a new home. And so we saw this unprecedented spike. In 2021, it continued, but not as much, up 18%. We're projected not 29 or 18 in 2022. We're projected to be 8% this year. And they're projecting, all the economists that are looking at this, a 3 to a 4% increase next year. Now, 3 to 4 to 5%, somewhere in there, is the average increase in real estate prices, residential single-family homes, for the last 50 years. So that's about average. If we can stay in that 4 to 5% range, that would be a normal market and without any kind of crash in the real estate market.
So it sounds like what Dave is saying is that, okay, we've seen this environment where home prices have increased a ton. That's not going to be the norm. What's going to happen is we're going to settle back to historic averages. So if the historic average for home price increase year over year over the last 50 years is somewhere between 3 to 5%, in his estimation, according to the economist that he's looking at, over the next couple of years, you can expect an average price increase on real estate of somewhere between 3 to 5%.
I thought it was interesting. Dave was standing next to a chart that looked just like the chart we set up the show with. It was that hockey stick where you have that huge run up in pricing. And our take on this is look, I think you have to kind of separate the different types of real estate. If this is a use asset type real estate, meaning it's your personal residence, that's going to have one set of criteria, or one way you can look at how to move forward. And let me talk about that. I think you have to ask yourself, if you're trying to make the decision of a primary residence, you have to understand the why. I mean, are you setting up roots in your neck of the woods that this is a place that you want your kids to go to school here? You want to kind of, you want to become part of the community, and you know you're going to be there for 7 to 10 years easily. Then I think you don't get so caught up in these huge fluctuations, especially if we're getting into a more normalized period of 3 to 5%. It's a use asset. You got to have a place to raise your family. You got to have a place to shelter yourself. So it kind of take that as this. We got to put roots down somewhere. For my investors out there, I've shared this many times, and Bo and I both have done real estate investing as well as traditional investing. And you just heard both of these people who are highly involved in real estate. Both Dave Ramsey and Graham are very much real estate people. And both of them alluded to the fact that there's a good chance that housing the appreciation of real estate will not keep pace with inflation. And in absolute terms, that's not good.
It's not a great thing.
And a lot of your money is made in real estate on the purchase, meaning did you get a good deal on the intrinsic value of what's going on? And I just worry if you're an investor, you might need to be a little more cautious. If this is a use asset to raise your family, make sure you're going to be there for that 7 to 10 years. Make sure you are in a solid, stable job, and all those factors of location matter. But when it comes to investing, be careful, because there might be better places to put your money if we are going to enter a period where housing doesn't even keep pace with inflation.